Hey guys, welcome to another Trade Genius podcast. Bob and Phil here as always. Guys, all you've been hearing about is inflation this, inflation that. Inflation's really bad. Well, guess what? It's not inflation you got to worry about. It's deflation. We're going to show you some really interesting data points in this video. So let's dive in.
Trade Genius.
Hey guys, I want to tell you something that we do that really will change the way in which you look at trading and also absolutely help you increase your profitability and how much money you make. It's the Trade Genius newsletter. We put the newsletter out Sunday night through Thursday night, and this really looks at the plumbing of the markets and helps prepare you for the next trading day and help you make money. And we give you a lot of information. We give you market statistics, we give you market levels, we give you the seasonality, what's happening with different sectors of the market, and we will help you identify whether the market's in a bear mode or a bull mode, or whether it's euphoric, whether it's despondent, and it just puts you in a position to be on the right side of the trade. So take advantage of our offer that we have below, and you'll love it. I mean, one trade that you make with this thing can pay for definitely a month, maybe even a year's worth of service. It's that powerful. Use promo code podcast for 15% off the retail price of newsletter. Thanks for listening.
So Bob, inflation's such a headline thing these days, and that's all the Fed's worried about. But it looks to me that that's really not the thing that is scary here at this point in the cycle.
Yeah, and before we get to the deflation data, which actually blew me away, I want to show a really cool chart for people because this is how Wall Street gets you on the wrong foot. So this is the bubbles that we keep getting into. That every time these bubbles go to the top here, Phil, it's always a brave new world, and you can just see. I won't read them all to you, but you can see all the bubbles that have popped, okay? And then the one they're trying to resurrect now with NVIDIA and Microsoft and Google is the artificial intelligence bubble. And it just pales in comparison, but it also shows you too that if you took Google, Microsoft, and NVIDIA out of all the indexes, we would be massively negative for the year. It says these are the guys holding everything up. And so a lot of companies jumped on the bandwagon, but they don't really have moats. And so it's really only those three companies that are doing it. But what I've been learning here, Phil, is, and as well, because you came from the technology side, there's no moats here with these AIs. Machine learning, nobody has a patent on machine learning, so you could teach your bot to do what everybody else's bot is doing. And then we're also getting a situation now where in Europe they're going to have privacy, and they're also going to be pushing things behind paywalls. So I think this thing burns out probably at the worst possible time for the market. And I just thought I'd share that people. This is such a cool chart. I thought I'd throw that at you. And if you don't have really comments on that, I'm going to jump into the deflation scenario because I think it's starting to shock people. And you kind of made a mention on one of our podcasts last week or Saturday that the Fed is they're already starting to reposition why they screwed up. And they're saying, well, maybe we can pause, maybe we can look, maybe we can digest the information. Well, this is what they saw I think that just stopped them dead in their tracks. Look at the Atlanta Fed wage growth tracker. I mean, Phil, that is a U-turn.
I think that's why they're talking about pausing all of a sudden versus another hike.
And the thing about this, Phil, is I was digging into the data, is that what's happening is for the very first time, we're getting services deflation. And what I mean by that is that you're getting a situation now where companies are like, okay, wage growth has become a problem in the service because I don't have enough people. And now technology is coming in to just basically wipe these people off the face of the earth. We mentioned a couple of weeks ago about SYM. Hope you guys bought that stock in from 25 to 29, by the way. That is a company that totally automating warehouses. Totally. So, a minimum wage guy is the guy that fills the boxes and the bins. The guy that makes $50,000, $60,000, $70,000 a year, he's the guy that drives the forklift. Well, guess what? Forklifts aren't going to be in these warehouses anymore. They're all going to be pick and packed by robots. And same with restaurants now. We talked in the past about what Taco Bell's doing, okay? And you're just going to see this across the board. And there was a really interesting article by Michael Green this weekend. He talked about how what they would call domestic servant services. In the past that meant maids and butlers and chauffeurs and stuff like that. But now it's really transformed into cleaning people, Uber people, DoorDash people, all all that is starting to collapse now too in terms of wages. And so we're starting to see that swap now fill between labor and capital is getting the upper hand again. And that's coming right when we're trying to reduce employment. Well, technology is going to just exacerbate that. And here's the other chart of the monthly change. Look at the magnitude of this, Phil. I think that's what's going to catch people so off guard on this. You know, you and I feel like we've been screaming at people about this stuff, and then all of a sudden you get these big, huge moves because they can no longer hide the data anymore, and they have to relent.
Yeah.
And then here's the one that's really important, because they always talk about inflation, deflation, but you never know like what percentage of people's income goes to where. Well, this does a pretty good breakdown in terms of, they call it Trueflation weighting. Okay. And the only one I really don't agree on is the healthcare one. I would still think that healthcare is probably a net positive.
Yeah.
But the only issue that I have here is that I don't have longer term data. It could have been up 3 months and now it's down just this month, kind of a thing. But I think the important thing to take out of this is that, you know, things are just simply collapsing in terms of pricing. Look, I went to the grocery store last week. I have prices back down pre-pandemic now, Phil. I can get chicken, I can get sausage, I can get beef. I can get all those things now for the same price that I got in 2019 and 2020. The only place that I think that prices are still too high, but I think they're coming down fast, is in the food and beverages area. Lately, I've been going out to eat. My bill for similar services now are about 25 or 30% less than they were, because they're offering more things as specials now. Because, you know, it's one thing to have a Trueflation weighting. The other thing is to take that and how many people are in the restaurants. And I think what they're finding is that people just can't eat out anymore, so they're not full anymore. But look at this annualized, you're looking at -8 to -15%. So we have to wonder, what is the Fed really fighting? And you and I have always been of the opinion, for me putting words in your mouth, and I'll let you talk to this too, is that this fight for the Fed was never been about inflation. It's always been, I think, about the dollar and the worry over the reserve currency, and also the worry about a federal government that is simply out of control. This is an intervention by the Fed to get an addicted government off of borrowing. And I'll throw it back to you and like to get your thoughts on that. And then we have a final chart to share after that.
I would tend to agree. I think that, and why we're having this debate in Washington about cutting things out of the budget, you know, it seems to me that there's a disconnect to a degree, because the spending is out of control. The debt's out of control. The debt with the interest payments are out of control. So if you're looking at it from the standpoint of the Fed's trying to get the US deficit down, then yeah, raising the interest rates kind of hits home the point to these guys, because you're getting to a point like Japan where you're going to have to run into yield curve control. And this is why Bitcoin and gold are in a position to really take off, because I think ultimately that we're going to get into that, because you got the Fed where on one hand they have to raise interest rates to cool the economy, on the other hand that destroys your ability to repay your debt as a government, right? And so you're going to have to implement yield curve control as a result. So it's just a matter of how soon. Now, Yellen actually already said she's going to do a treasury buyback program in 2024, which they don't want to say yield curve control, but guys, that's what yield curve control is. You're effectively going in and manipulating the bond market, right? So it's not a free market anymore. So yeah, I kind of agree with you on I think there's a bigger agenda here regards that. I kind of agree. You know, you have to agree though. You have to get that deficit under control. So
I totally agree. You want to transition to this last chart, even though it's a non sequitur, I thought people would appreciate it, is that this is the 13-week T-bill. And whenever it gets to this range, each one of those mountain peaks were beginnings of stock market sell-offs and recessions, okay? And we're there again. And, you know, our view is, I always say my view, but I think Phil's in total agreement with me, is that once Yellen has to, you know, basically sell $1 trillion worth of treasuries, this going to just drive everything into the floor here. So we probably will get a little bit more of a bump on, well, the 13 T-bill may not move so much, but I think we may get a bump of the 10-year rate and the 30-year rate. And then the whole thing comes cascading down. So that's my only concern with the Yellen thing, because I have a lot of bonds. I have a lot of 13-week T-bills, but I also got 20 years. And I'm watching the 20-year yield bonds because they may go against me before they go very much for me. But I think these 13-week T-bill rates are probably going to, you know, hover, maybe get another half point higher. And that's just all they're going to go before this whole thing collapses. Look, bank credit is disappearing, Phil. I think I mentioned last week is that the independent auto lenders are gone, no more, and the only other people out there would be credit unions and these regional banks, and they're locking down. So I think you're going to see this whole thing collapse in and of itself. The government's going to be really the only people that are going to be able to borrow money unless you have a lot of collateral that you're a sure bet. And that's what rolls everything over. But we're still the same opinion that as soon as Yellen gets to go ahead to start selling bonds, then you need to steer clear of the stock market. It sounds like they may screw around with this thing all the way up into maybe June 10. I'm hearing now June 10th is they have money for 10 more days. We'll find out more today, Phil, correct, if she drained it some more. But then other than that, don't do too much, guys, for the next week or two unless you try to grab a trade here and there, because once she gets to work on it, she'll be the only game in town. The stock market has to give up its capital for her.
Look, I will refer back to this monthly change chart on the wage growth tracker. And that is a insane drop in month over month. And look at it compared to when we had real pullbacks in the market, real recessions, right? The dot-com bust, 2008. I mean, this is smoking those levels, Bob. So You're foolish to think just because it hasn't happened yet or it's being prolonged out another 3 weeks, it's coming. Don't make no mistake. And it's really going to start with Yellen reissuing that debt. So, when you guys are talking about, when's it really going to hit, or you guys have been pushing this along and it hasn't really happened yet. I really think that when the debt ceiling gets raised is when it's really going to kick off. But if there's anything that I would say before the debt ceiling gets agreed to, if they don't meet the X date, if we do start to actually have default worries, you're going to see this market drop like a stone. I mean, it's just going to go straight down, the biggest red line you've seen in a long, long time, because there's significant ramifications for a default here. And like we were warning you guys months ago, if ever there was a cast of characters that could actually get us to that point, it's here and now. It's these guys. And it's because, I think on the GOP side, they're willing to dig in. Whether or not they understand the ramifications of a default, I'm not sure. But I just think that how things go in Washington, and they might just dig in to the point where, or they have an idea of, let's let it go for a couple of days. Technically, it's a default for a couple of days, just to kind of prove a point, kind of a thing. It's a dangerous game. I think we should get a resolution beforehand, but I also think that there should be some longer term compromises as far as what we're doing as far as spending, because it's unsustainable, and that really has to get addressed, or we will have a problem that we will not be able to control.
Just remember, the Biden administration is like Alice in Wonderland, and they redefined the reality of everything. So I wouldn't be shocked at all if they tried to do something unexpected and really cause some grief. But in lieu of that, it doesn't matter, Phil. If they don't default, we're going down. If they do default, we're going down. It's just a matter of the magnitude, and the length of which the sell-off's going to happen. So it's time to be careful here. We're really dealing with politicians now, and they're not looking at this thing economically at all.
Yeah, Bob makes a really good point. It doesn't matter if the debt ceiling is raised or isn't raised, because the only thing that's been lifting this market is Yellen's bank account, okay? The Treasury General account. That's it. And it's done. It only has a couple more days of trying to put liquidity into this market, and then that's done. And then if the debt ceiling does get raised, she's going to be busy building that account back up, which sucks liquidity out of the market. So I want you guys to be really, really clear here that the effects we've been witnessing over the last few months from Yellen spending basically what she's had in the account, spending it down, those effects are gone. One way or the other, they're gone. So there's no good news for this market as far as fuel for the upside. And it's very important to understand that regardless of the outcome here. So there's no good outcomes as far as liquidity goes. And that's why we're pretty bearish from here on out on the market going into, you probably have a swoon or drop down into, midsummer or so.
I agree. Well, that's all I have, Phil. Thanks, everybody, for listening. Hit like, hit subscribe, hit notification bell. Just check us out. We launched our new indicators. So if anybody's really interested in having tools that you can really, really be ahead of the game, I think we're going to talk about those this week. If you don't mind us shilling a little bit for some of our services. But I think you'll be blown away. You'll really like these things. They're going to be excellent tools for you. And with that, Phil, I bid you adieu.
All right, guys. We'll see you on the next one. Take care. Bye-bye.